Good evening, everyone. We shall try and um, explain to you during the presentation and thereafter the importance of managing your monies well. And that my own belief is that the dearest thing to an individual is his family, and the second most dearest thing is his money. And in my experience, uh, people give a lot of importance to their work, uh, spend inordinately large proportion of time with their work, some bit with their family, and very little with their money. And maybe uh, this will inspire you to maybe change the proportions of how you spend your time. I'm assisted by Aarti, who will take us through the presentation for the next 10, 20, 25 minutes. And thereafter, we'll all try and address any query that you might have. Thank you for coming over, and over to you, Aarti.
Thank you, sir. So I'm going to start with, something very simple because we're here to talk about wealth management. So let me start with defining, what some of these terms are, because we use it regularly, but it's important to define what these two terms are. So let me start with wealth, right? Our understanding is that wealth is the sum total of all the assets that you have. Now, many of you may have monies sitting in just a bank account, or it may be in other investments, which is shown here. So something like direct stocks or equity mutual funds, bank balance, other asset classes, right? But very simply, everything that you own is your balance sheet, and that is what we define as wealth. Now, there's a slight difference when it comes to what is the wealth that you want to manage, right? So if you look at it, we define wealth, like I said, as a sum total of your assets. But what are the assets that you would like to manage are your assets minus your aspirational assets. So what is an aspirational asset? Very simply, maybe the house that you and your family want to buy, or a holiday home. And these are bought not with the intention of making returns or money, but this is just to take care of your aspiration, right? Now, let me move on to the second part. Therefore, if we've understood wealth, what is important when you're looking at managing your wealth? So we think that there are 4 simple steps. What are these steps? Step 1 is defining your objective. Now, your objective may be very different from the person sitting next to you, but it is extremely important that we spend a lot of time on this step 1. Define your objective. What do you want out of investing your money? Where do you want to go, right? Once you've decided this objective, then the next part is equally important, which is deciding, with certain principles in place, what is the strategy in order to achieve these objectives. The third step then comes in, which is you have the right objectives, the right strategy, but implement it. This is where we get caught many times and we implement it in parts, or we say we'll wait for timing the market. But please implement your strategy. And then the step 4 is constantly do an MIS, or look at monitoring the direction of whether your strategy is really helping you reach that objective. Are there any changes in the environment? Are there any changes in your objectives? But monitor it. Now, these are 4 simple steps that we believe is what is part of management. And if that is what is management, and that is what many of us have studied in our MBAs, it's no different when you're managing wealth. Right. So let me now go forward and spend a little bit of time on that first step, which is objectives. Now, traditionally, when we meet a lot of clients, they come up to us with what we call consumption objectives. How much do I need to have in order to take care of my children's education? How much do I need to take? How much should I have if I want to retire? How much should I have if I want to build a house? Right now, all of these are what we call consumption objectives. That portion of your wealth that you are going to consume for various objectives that you may have. Now, in our process of doing wealth management, what we realized was there's a second way that one can look at objectives, and that is called the compounding objective. If you could have a return objective, right, in the range of maybe 10, 12, 14%, 2 to 3% higher than inflation, it would not just help take care of all those consumption objectives that you have, but it would also help you grow your wealth, grow your purchasing power of wealth. So we actually look at objectives not just as, how much of wealth should I have in order to take care of my consumption objectives, but we actually look at it as if you could grow your money at a rate of return of 12 to 14%, it would take care of all your objectives and more during your lifetime. Now, I spoke about two things in the previous slide, right? I used the word compounding. And what best way to understand compounding but with data? So let us just look at a simple example of if an individual invested around 10 lakhs for 20 years. Right? You have the options of maybe putting it in a fixed deposit, of investing it into real estate, of investing it into equity, of investing it into various assets or products that are available today. The difference of why you would choose one over the other is if probably you understood what is that difference or what is the impact it is going to make to you. And that is the impact of compounding. If I invested my money at 6% for 20 years, this 10 lakhs would grow to around 32 lakhs in 20 years. On the other hand, if I grew it at 15%, it would grow to almost 1.65 crores. Yes, I'm just using the... So the difference of that is, what really determines of whether you want to take that decision of still keeping your money in a fixed deposit and, earning 6%, or are you willing to take that little bit more of risk, understanding what your options out there are, and growing your wealth to such values. And I think this is, one of the reasons why we call compounding the eighth wonder of the world. Now, along with compounding, comes another part that is very, very important when you're investing, and that is starting early. I can see a lot of youngsters here today, and so I think it's important for you all to understand that when you all, have this question in your mind of, can I also become a high net worth individual, which is approximately earning or having wealth values of 5 crores and above? The answer is yes, and you can do it in a very, very simple manner. If you start early, this example just tells you that if at the age of 20, you can put aside 10,000 rupees per month in a disciplined way, month after month for 40 years, and choose maybe an asset class that can give you a return of around 12%, over 40 years, what you would have invested is around 4.8 crores. But what the wealth value would have grown to is almost 12 crores, 11.8 crores to be exact, right? 48 lakhs, sorry, my mistake. You would have invested 48 lakhs and 48 lakhs would have grown to almost 12 crores. Now let's look at it as to whether you started not at 20, but at 30, right? You would have invested 36 lakhs for 30 years, and this would have grown to around 3.5 crores. But if you started only at the age of 50 and did the same exercise for 10 years, you would have invested 12 lakhs and that would have grown to around 20 lakhs, right? The difference between having almost 12 crores and just maybe 20 lakhs was this simple rule of starting early and being really disciplined of just putting aside 10,000 rupees every single month. So our suggestion to all of you sitting here is, given that you all are starting young, please start with a disciplined approach of putting away smaller sums of money. You don't have to put aside large sums of money, but this will add up to great wealth values over a period of time. A second way of explaining this is by taking maybe one consumption objective, right? We have a lot of people who want to know, if I want to retire, what should I do? Right, so we've taken a simple example here. A couple who is 40 years of age, looking at retiring at 60, and they want a corpus which will take care of their expenses, which in today's terms is around 2 lakhs per month or 24 lakhs per annum. And this needs to be inflation adjusted, where we're looking at inflation at around 6%. So if we take life expectancy at around 85 years, all that they need to do is, again, put aside 1 lakh per month for the next 20 years, right? And therefore, what would they have put aside? They would have put aside 2.4 crores over the next 20 years. But what they would have at the age of 60 to take care of their retirement is almost 10 crores, right? Given that this is a couple starting at 40, they need to put aside maybe around 1 lakh. If you are starting this exercise in your 30s or your 20s, all that you would need to put aside for the same goal to reach the same place is maybe just half the amount or 1/3 the amount, right? So I think with the last 2 slides, it's very simple. What are the takeaways? Please start early. Please invest into an asset class that can earn you maybe 3 to 4% higher than inflation. And please be disciplined in the method of investing, and compounding will do the rest. One point that we should probably just spend 2 minutes on is, I had spoken about in the previous example of inflation adjusted expenses. So what is this term? We keep hearing inflation, right? The government defines it as CPI, but let's forget all of that. Inflation is very simply, if you have certain expenses today, right, what is it that is going to cost you next year? Is it going to be the same? Is it going to be higher? Right? And what is it going to cost you the year after that? If we assume that inflation is 6%, all that we are trying to explain in this example is that today, if you are able to buy something for 1 lakh, tomorrow, that same expense that you have or that same objective that you have may cost you around 1.5 lakhs the next year. It may, in 5 years, it may cost you around 2 lakhs if you have the same objective after 10 years. And therefore, inflation, while it's an invisible element, has to be taken into account when you are doing your planning. Another way to look at it is the other side of the slide, which says that if I can buy something with 1 lakh today, that same 1 lakh is going to be able to buy me only maybe something worth 21,000 20 years down the line. So please keep inflation in mind while you make your investments. Keeping money in safe assets is not something that is wrong, but it may not help you 20 years down the line when your purchasing power of wealth hasn't really improved because of that decision. Now that we've understood certain basics about the objectives, let us now look at, so therefore, what are the solutions, or what should one keep in mind if I really want to earn this 12%, right? Step 1 is that when you have your savings, monies need to be bifurcated into 2 buckets, right? One bucket is monies that you require for immediate consumption objectives or emergencies, anything that can come up in the next year, year and a half, 2 years. That money should be invested in such a way that there is absolutely no risk, right? So park those monies in what we call short-term investments or fixed deposits. That's your safest way. The other bucket is what we call your long-term bucket. These are monies that you don't need to touch for any of your needs for the next 5 years, 10 years, 15 years. So therefore, it is sensible to plan these monies in a very, very different way from what you would do with the first bucket, right? So let's now look at, if we are focusing on the long-term bucket, what are some of the principles that we need to keep in mind? The first step is, please look at what are the asset classes that you would like to invest into. So before that, let me tell you what are the 4 asset classes that are there. There is your low-risk asset class, which is debt, or what you all may know as fixed deposits, right? Very, very low risk. Then you have commodities or gold as an asset class, real estate, and then equities. which is what we have called, put as the benchmark, which is the Sensex. Now, these are your 4 asset classes that you have the choice to invest into. If we go back and assume that we had put 10 lakhs into all these 4 asset classes, let us look at what those monies would have grown to in today's terms. So if I had done this exercise back in 2002, what would that be looking like in 2022? So if I had invested into a fixed deposit, my 10 lakhs would have grown to approximately 40 lakhs at a compounded rate of return of around 7%. If I had invested this money into gold, it would have grown to maybe around 56, 60 lakhs. If I had put this money into real estate, and we are looking at real estate on the whole as to how it's done, the odd piece of real estate I'm sure has done better or worse, but on an average, if you had real estate which grew at around 10%, your 10 lakhs would have grown to 70 lakhs. If you had put this money into the Sensex, your 10 lakhs would have grown to around 140 lakhs or around 1.4 crores at a compounded rate of return of around 14%. Now, in equity, I'm just going to introduce one concept here, which is you can invest into equity through a simple product called a mutual fund. So we have just looked at 4 or 5 mutual funds that were there at that point of time 20 years ago. And on an average, those mutual funds were able to do better than the Sensex by around 3%, 3 to 4%. So if you had put 10 lakhs into these diversified equity funds at that point of time, and it had grown at around 18%, you would have had almost 2.75 crores today. Now, if I had just thrown these values at you and told you I can grow 10 lakhs to 2.75 crores, nobody would have believed this. But this is data basis historical values of what the markets have done in the last 20 years across all 4 asset classes. And the only reason we are putting this in front of you is not to tell you that you have to choose equity as an asset class. But if you understand the difference of how your wealth values can grow dependent on the choice that you make today, I think it would change your decision if you knew how this could pan out for you and your family over not a period of 100 years, but just a period of 20 years, right? So choosing the right asset class is very, very important. And, we've just put this down as certain, key takeaways, which is that today in India, if we look at it, almost 94% of the wealth in India is invested actually in the first 3 asset classes, which is fixed deposits, gold, and real estate. And only around 6% is invested into equities. But as you can see, equity has delivered the highest rate of return across these 4 asset classes. And therefore, coming back to the point that if your objective is 12%, choosing equity is probably the right way to go. Else, one would have to be satisfied with a return of around 6 to 8%. On the same line, maybe the question is, fine, this is what India does. What do rich nations do? So we've gotten this data as to what do other nations do and how do they invest across these asset classes. And as you can see, almost 40% is invested between equities and alternative investments. If it's 6% in India, and even if it grows anywhere towards what the rich nations do, you can understand what is the kind of values one can see in equity over the next couple of years, right? Now, I've only spoken about the good part of equity, which is the return side. But obviously, there is also the other side of the equation, which is risk. So let me take you through what are the risks of equity, or what is the one risk you should keep in mind if you are choosing equity as an asset class to invest into, and that is volatility. Now, I think volatility is something that all of you must have seen, especially over the last few weeks. Markets going up one day, going down the next, and we're hearing a lot of news in the papers about whether the markets can go down another 10%, another 20%. Can it happen? Absolutely. But what should you as an investor look at if you are investing into equity? Should you look at what is going to happen tomorrow? Or should you look at what will happen if you invest for the next 5 years or for the next 10 years? So what we have done in this chart is really put down what happens if you invest into equity with just a time period of 1 year? You can either be very, very lucky and make returns of 32% in a year, 92% in a year, or you can lose wealth values of almost 50 to 55% in a year. If you extend that period right to the bottom of a 10-year period, you can see almost a flat line, right? Your volatility or the spikes in the returns that you make completely come down, and your returns would almost range closer to the average. And what is that average? The average return that an individual has made if they stayed invested for a 10-year period, as can be seen in this slide, is around 13%. Right? So what am I really trying to say? That volatility, is it a risk? Yes. But over a longer term period, it converges to very, very small values. On a 10-year period, the average return that an investor has made in the equity market is around 13%. Now, on a 10-year basis also, the minimum return that an investor has made is almost equal to a fixed deposit. And when we talk about risks of equity, the first question that you have is, I don't want to lose money, but I also don't want to make less than what I would make in a fixed deposit. And the answer is here. If your horizon is 10 years, people have actually not made less than a fixed deposit, right? Therefore, if volatility is the problem, long-term investing is your solution. Now that we've understood the return aspect and the risk aspect of equity as an asset class, how can you invest into equity, right? We believe choosing the simplest mode of investing, which is mutual funds, is a good way to invest into this asset class. And it also is able to deliver what we call an alpha, or a slightly higher return than what the benchmark does. So if your benchmark is the Sensex or the Nifty, good diversified equity funds in the market are able to earn 3 to 4% more than an equity mutual fund, thereby taking care of this objective that you have. Now, again, don't take my word for it. Let us just look at what some of these funds have done over the last 20 to 30 years. So we looked at this data, back in 1995, when there were only very, very few funds in the market. Let's assume you did not even have an advisor at that point of time, but you just chose to put your money equally into these 10 funds. What does this data tell you? Over the last 27 years, if you look at the last line which says benchmark Nifty, the Nifty has moved. If you had invested 1 lakh, it would have grown 18 times or grown to 18 lakhs. However, if you had had a basket of mutual funds, and I'm not even talking about the best mutual funds, if you had had funds that did worse than the Nifty and funds that did better than the Nifty, on an average, your 1 lakh would have grown 60 times or to 60 lakhs, right? So therefore, I think all that we are saying is that professionally managed mutual funds with good fund managers who understand markets, understand stocks, have good research teams, are a good way and a simple way for you to choose where you want to invest or how you want to invest into equity. If the question then is that if I'm just starting, what should my mutual fund basket be that I can probably invest into? We have just put down a few schemes which go across your large cap, mid cap, and small cap basket. And you could choose 4 or 5 of these schemes which have done very well in the past, which should be able to take care of your objective. And I think the last point that I will cover is that if you are starting today, if you have not invested before, and your question is, I like what I see, I want to invest, but I don't know where to go or what to do, you can invest today in 2 manners. You can either go directly through the mutual fund itself and do your research and choose whichever fund you want and invest directly. What is the advantage of this? You save something called a management fee, which is in the range of maybe 0.75 to 1%. The other way to do it is to go through your bank or to a broker, or there are certain apps that one can use, or you can go through any intermediary, and they would be able to help you with what you should do and maybe with schemes you should invest into. Why is this something that people may look at? For the simple reason that today there are many schemes in the market, right? There are almost 450 schemes that you have to choose from. And choosing from this may be difficult because the range of returns, the range of risk that each of these schemes have is different. And therefore, if you do not have the time or the ability to do this entire exercise, please do go to some intermediary and they should be able to help you start off. I would like to end with that because I think there are a lot of questions that you all may have, or a lot more that Mr. Rakesh would be able to share with you, whether it's views on the market or any other questions. But this was just to introduce to you the basics of why should one invest, why should one save, and why should one have the discipline of long-term investing. So with that, I will hand this over to Mr. Rakesh Rawal.
Thanks. Thanks, Aarti. I wish you told me this 40 years ago. I would have been rich. Okay. Let me start off with a couple of questions and then throw it open to them. Okay? Lots of people are panicking seeing the market now. I know that Aarti talked about it, but nevertheless, so people think maybe we should move some money out of equity, add some gold, add some real estate, things are going haywire, etc. How would you advise them?
One has to understand as to why we get returns in equity over a long period of time. The backup of the equity is a company, right? And if that company is growing its profits at 10, 12, 13% over a long period of time, that profit sort of converts itself in some fashion or the other into the stock price. So if you have a company which is not growing, obviously the price won't move. Now, in your opinion, just make a judgment that if the economy is growing at whatever 6, 7, 8% real rate of growth, add to inflation to that, that's nominal growth of 10, 12%. What does that mean? It means that the economic activity is growing, which then creates opportunity for businesses to grow. And if businesses grow, their top line and bottom lines grow, which means that profits are likely to grow for the next 5, 10, 15 years. If profits grow, then you'll get your returns. Now, if we start this exercise, okay, let me just give you the Sensex was in 1980 100 rupees or 100 points, and today it is whatever 50 or 1,000 points. Somebody was very smart and he started at 100. The other person was not so smart and he started at 300. Is there any difference in the returns that they have got? So I think that all these short-term volatilities are red herrings that take you away from your pathway of long-term investing. And you should be aware of it, that long-term you'll make your returns because that's what history shows, and stick to your strategy and not be diverted by the noise that is there in the marketplace.
Great, thanks. Just one more before I open it. Though the presentation clearly showed that the longer term is, longer you invest, it's better for you. Nevertheless, young people have a hard time finding savings because they think that's the time when, they need to spend. They have a lot of needs, they've got EMIs, etc., etc. And many of them will say, I will see when my salary goes up after 10, 15 years, I'll start saving. Today, if I start saving, I have nothing to live on. How do you balance the two needs?
Again, sir, this is all about intent. I know the exact method of losing weight. Yeah. And if I don't follow it, I'll be fat as hell. And if, it's your money, it's what you're earning, and you're allocating it to different things, including savings, you will always find reasons for not allocating it, and you will always find reasons to allocate it. It's your money. The numbers are there in front of you. If you wish to do it, excellent. If you decide not to do it, so be it. And I shall suffer the consequences of not looking after my health, and you will suffer the consequences of not looking after your wealth. It's as simple as that.
Great. Anyone wants to ask questions, please come down to the mic. And
Hi, thanks for your session. Can you hear me?
Yes, yes.
Okay, great. So you glossed over it in your presentation, but I think it's something that we all encounter. Inflation in India right now is at an all-time high, right? And that's an invisible tax that we all pay, because the more essentially it kind of eats into my purchasing power, and what I got for 100 3 months ago is not what I get. I probably have to pay 120, 130 for what the same goods that I bought. Now, inflation also kind of pushes me now today. If I want to stay in the same place, I have to earn more. And if I'm earning more, I'm also pushed into a higher tax bracket. When I'm pushed into a higher tax bracket, I'm paying the government more. So, could you give us, because you mentioned certain asset classes, right? Gold, equity, debt, broadly. What asset class would you recommend that kind of helps us hedge against inflation? While equity, you rightly mentioned, helps you hedge against inflation by 6-7%. Gold, as an example, kind of stores your value. So if I go and buy, 1 kilo of gold today, 50 years later, I will have that same 1 kilo of gold, and hopefully gold prices have gone up. So, I've managed to kind of save my value. But apart from, these kind of commodity-based assets, what would you recommend that allows you to kind of...
See, the point is that inflation is a risk, and it is, we've seen 5-6% average in India, US 2%, and we are likely to be 3 to 4% higher because we are, an emerging economy, and the purchasing power parity has to come in over a period of time. So the cost of bread here in dollar terms will be far lower as compared to there. So the world has to sort of come to that a common price point. So we will have inflation. That's a reality. Yeah. Now the point is, you have to have your objective, which takes into consideration this inflation. So, like I said, that if you have an objective of 12% and your inflation is 5, you have an objective which is 7% real rate of return. So, if you focus on that 12% and get a mechanism to deliver that 12%, automatically the inflation is taken care of, because your wealth has grown at a rate much faster than the cost of assets.
Sure.
Right? Now, you're right when you say that, hey, if you buy some commodities, since you're storing your wealth in commodity, right, the inflation which has happened, the commodity being the same, the value you will get is a higher rupee value, but you're not losing wealth, so to say. Yeah. So if your objective then is that I want to do 6% plus 1%, then the strategy is different. They put your money in debt funds and stuff like that. Yeah. So the strategy emerges from your objective. So again, go back to principles. Objective is the starting point of managing anything. Be clear on that objective, what you want. And that's why we say that strategy depends on that objective. So if there is lack of clarity, if I'm saying that, hey, I want to hedge, hedging is for a purpose. You want to hedge for what purpose? The purpose is, I've got 100 rupees. 10 years later, I don't want the purchasing power to be less than 100 rupees. That means your objective is 8%, 7%. Then there's a strategy. If somebody says, hey, I want my wealth value to be much more than what it is today in terms of purchasing. He chooses 12%, then he has a strategy at 12%. So does that directionally answer what you had in mind, or is there anything else?
Yes, it does answer it to a certain extent, but it doesn't help because traditionally people say that real estate helps you lock in from inflation. Gold and commodities can help you lock in from inflation. But equity today, if you look at the Nifty, it is the same as what it was a year ago, right?
Yeah, you're right.
So I could have invested a year ago and I would still have the same value, but the value of the money is kind of lower because I've lost time, which is at the end of the day the ultimate currency.
Let me give you another example. It's you're saying same value, and when the COVID period came, the value diminished by 26%.
True.
Right? So it's not the same. It could in 1 year be down 26%. That's volatility.
Sure.
Right? So therefore, if my objective is what will be my wealth value in 10 years, what is the purpose achieved by measuring it on a daily basis, yearly basis, 6-month basis? Because if you measure it, that information should lead to some decision.
Sure.
Right? And if that decision is going to be, so therefore, supposing there's some massive change in the economy, and suddenly, the political, economic structure changes, and we suddenly move from 7% to 2% GDP growth. Yeah? So there's some structural change which will impact the expectation of return from equity. Fair point. At that point in time, you want to make some changes, you do that. Yeah? But if generally you are there, now if you look at last 10, 20 years, people have come, people have gone, this economy is growing. Yeah? Sometimes 6%, sometimes 5%, sometimes 8%. Yeah? There's some, friendly government, some, so all people have come and gone. What's the one common factor? That the economy is growing. Why is that economy growing? Not because of A, B, C, because of all of this. All of us.
Sure.
Yeah?
Good. Thanks.
Thank you very much.
Good evening, sir. Sir, as a youngster who is beginning his investment journey, if you could throw light on what are the mistakes that he should avoid when he is starting his investment journey.
See, the point is, it's all very easy to say long term. Right? And so, investing, there is a mind element and there is the emotional element in investing. Yeah? And we will all learn with time. So I start a journey based on all the math and I start the process. There's volatility in my markets, to bring it down by 20%. There's so much of fear that grips me, right? And then I take out my money. So what has happened? I invested at 100, took out at 80, booked a loss at 20. And that experience is so overwhelming on me that I never entered that asset class ever again. Yeah? So you have to be very careful that when you say long-term investing, you must have the grit to tide over all these crises. If you don't, then 12% is not yours. Yeah?
Thank you.
Hi, sir. My question is on the platform. So, when we speak about equity asset class, there is direct equity, there is PMSs. What comes out, in the presentation is why do you suggest a mutual fund as a platform compared to other platforms?
See, the point is that if you invest in a stock, we saw volatility, yeah? So a single stock, where, for example, we saw the index volatility during COVID times, where the index was down 20%. But you could find stocks which were, 70, 80% down. So the ups and down, the pendulum going up and down, is highest at a stock level, and it is, shall we say, reasonable at a group level of stocks. So mutual fund is a group level of stocks. So there are 20, 30, 40, 50 stocks within this that are there. So one goes up, the other goes down. So therefore, your net volatility is low. So that's one, that you must have a group of stocks. The second thing is either you manage it on your own or you have a guy who's been doing this exercise for years in his lifetime, manage it. Make a judgment for yourself that can he do a better job than you? And if he can, then go to him. Right? Do you have the skill set and the knowledge to do it? And I can tell you, embarking on this pathway of equity without skill sets is fraught with danger. Yeah. So my recommendation would be that, hey, value the experience and the the knowledge that these groups of people have, and bet on them rather than on yourself. I wouldn't do it on myself. I bet on mutual funds.
Sure. Thank you, sir.
Thank you.
What about the young cowboys who are, doing day trading and claim that they make money on it?
Well, it's the same pack of cards. You can play bridge or you can play teen patti. It's up to you how you want to use them. So day trading is like gambling, where your probability of success is much lower. And investing, your probability of success is much higher. So it's your money, what you want to do with it.
So I had a question regarding real estate. So it's quite a conundrum because on one hand, there is this compounding going on there as well with the EMIs. It's just in favor of banks, and because it takes such a huge chunk out of savings. What would and then you also showed the chart which said like real estate only appreciates at 10%, which is kind of on the more conservative side. So I was very curious to know, what your advice would be. Would it be better to like save a bigger chunk of down payment for like the next 10-15 years and then choose to pay the bank lesser compounded interest? Would that work out better in favor? Or
See, it's a question of, it starts from an aspiration.
right?
That I want to buy a house and live in it. Yeah.
Yeah.
The rental yields of most real estate is 2%. Yeah. So if I am living in a house which otherwise has a market value of 1 crore, then I am paying annual rent of 2 lakhs for that house. That's what real estate today is. Right? So ask yourself that if I can take 2% and pay 2 lakhs, do I want to invest 1 crore to be in that house? Mm-hmm. Now, why are you doing that? You're doing that because you have an intense desire that काम कर रहे हैं, सब कुछ कर रहे हैं, एक घर अपना होना चाहिए. Right? All of us have that desire. So it's a question of when you want to fulfill that desire. You want to fulfill it right now, you want to fulfill it 3 years later, 5 years later, 10 years later. The more you spend time and then fulfill it later, it will be less impactful. So which means that if you do it 10 years later, 10 years your savings are growing at 12%, right? And then you're putting some part of it into the real estate, and the cost of real estate is not growing at, well, historically it's 10, but the next 5-10 years we expect it to be not more than 5-6%. Yeah. So if your money is growing at 12, your costs or money required to buy the same real estate is growing by 5. There's a differential that is adding to your favor. So if you can, examine it within yourself and the family. Do you want to do it now or later? My recommendation would be to do it later. Let there be more solidity in your investments. And then when you embark on that purchase with that solidity, the ups and downs and your consumptions don't get impacted that much.
Got it. Thank you.
Does that answer?
Yeah, it does.
Lovely. Thank you.
Can I ask another question?
Of course.
Okay, super. So typically as I understand, I'm not very kind of conversant with mutual fund investing, but from whatever little I've read, the origin of investing in equity in a company was because you really believed in that company and its growth. and then you took a blue chip stock and stayed invested in it for very long. Does that still hold? I mean, if we didn't want to get into, the more layered mutual fund to begin with, and if we could identify like some startups or companies that we really believe in, need not be unicorns, but just companies that are growing in a very solid way, would that also hold well for staying invested for the next 10 years or so?
Absolutely, it would. But understand the risk return matrix. So, if, for example, you have a company investing, then you are expecting to get from that the profit growth
Right.
from that company. So if you take a big company, your IT, big companies, you yourself know what kind of profit growth, 10, 12%. Yeah. So the price points will be, say, in that same range of 10, 12%. Yeah. The volatility, however, is far greater.
Okay.
Yeah, because it's a single stock, no?
Okay. Right.
So there'll be some event that'll be then, price will shoot up by 20% or come down by 30%. So the journey will be far more with, ups and downs. A mutual fund, you get returns likely to be much higher because they're not betting on only these big companies. They're betting on a combination of companies which are likely to earn 10%, but there are several businesses in our country which are likely to earn 15, 20%. Yeah. So the combination seems to be much better there. Now, I may not have that knowledge to identify all those companies.
Yeah.
So option one, again, go by my knowledge. When you're going to do it part-time, 10, 15 minutes, half an hour per day, as against a person who's done it for 20 years and does that as a living 10 hours, 12 hours a day. Who's likely to win the race is up to you to make a judgment.
Right.
So you bet on that horse. Even if it's my neighbor's horse and not mine, if it's going to win me the race, so be it.
Yeah.
Yeah?
Thank you. Yeah.
Thank you.
Hello, sir. So this is just a small question which popped up in my mind. We've always come across this one acquaintance of ours who's probably trying to sell us insurance, or somebody from the bank, or some way that way. So, what is the importance of having insurance as a part of my, either as an investment in my portfolio, or how do you perceive that, sir?
Yeah. So, go back to the first principles. The principle of insurance is that we are all collecting money and say life insurance, that if one of us is unfortunately, taken away, then from that corpus I shall pay the family. That's the principle of insurance, right? And that's what is called as a term insurance. Yeah. So insurance is a cost that I incur that cost, and the benefit is that if something happens to me, my family will get 20, 30, 50 lakhs, a crore rupees. If nothing happens to me, then that's a write-off. Because I lived that 1 year with that satisfaction that, hey, had something happened, my family would get 40, 50 lakhs or a crore. Now, what's happened over a period of time is that the insurance objective has got mixed up with investing objectives. Yeah. So therefore you have all kinds of insurance policies which are a combination. So they'll take larger premium, some part they will put into the insurance fund, and some part they will put into investing. The pan out so far over the last 10, 15 years is that the mutual funds have done a far better job in terms of creating returns than insurance companies. Yeah. So my recommendation would be, look at insurance separately, take your term policies and so that you can safeguard your families, and investing separately. Don't mix up objectives.
Thank you. That makes it a lot clearer. Thank you.
Thank you.
Good evening.
Hi.
I just had a couple of questions. One is, according to you, as of today, what are the pros and cons of network marketing?
Hmm?
Network marketing?
Network marketing.
Yes, like you have Amway and QNet and a lot of other. Um, that
I
is- Okay.
I won't be able to comment on that. I have
Okay.
no knowledge on that subject.
Right.
Sorry, as a marketing tool or as an investment?
As an investment tool.
So she's saying you become an agent for Amway to make money.
I won't comment on it because I don't know that subject.
Right.
I don't know how the money is made in that business,
Right.
and I don't know the risks of that business.
Got it.
So,
So it's an
you know,
individual assessment of.
well, I'm sure there are other people who can help you out with this.
Right.
Since I don't have knowledge, I don't want to comment on it and give you the wrong advice.
Sure. Then the second question. So coming from a different angle now, earlier society dictated retirement to be 60. But today, it's a shift, right? You want to retire by 35 and probably travel or not invest in a home or any of those. So would the approach completely change? Because here we're looking at 5, 10, 20 years. And by the time you decide you're 28, 29, maybe 30. So then how do you look at it? Because you want to do things, you want to be young and to be able to do things. So I wondering what the approach would be then.
Well, first pray that you're born to a rich father. That helps in the whole process. So what does that do? It gives you starting capital that is large.
Right.
Yeah. What does a rich father do? He gives you starting capital of a few crores of rupees, which you grow, and you get to that corpus of 10, 15 crores at which you can retire.
Right.
So it's a mathematical thing. That if you have 10 and you need to get to 12, you can get there in 2 years, 3 years, retire. If you have 0, right, and you need 12, then you need to work that many years to get there.
Right.
So there's no complex or simple answer. It's mathematical.
Right.
Your needs are defined by you in terms of what you need post-retirement. You have to decide that, okay, for leading a reasonable life, traveling, and so on and so forth, I'll need 20 lakhs per annum, 30 lakhs per annum. That 30 lakhs has to come from somewhere.
Right.
That somewhere has to be built.
Yeah.
And if you have to build something, what's your base? If you have a large base, it'll take you less time to get there. If you have a small base, it'll take you larger time to get there. And therefore, my aspiration, in some cases can be fulfilled in 10 years. In some cases, it may take 20 years. And I think life expectancy is going up. Yeah. So there's enough and more time to enjoy the process of creating wealth and also enjoy the process of utilizing it, enjoying it. ये जो जल्दीबाजी का system है ना, this is something that one has to question. And in any case, patience, if you don't have, don't get into investing. What did we say? 10-year investing. 10-year investing means patience. If there is lack of patience in me, then please don't embark on this pathway, but I can give it to you in writing that you'll have a negative experience.
Right. Not in a quick way, but even if you look at a 5 to 7 year, because now the intention, as you were talking about, is towards being financially free, which means you want to do that earlier. So even if I went through, what would you recommend in terms of, let's say, stocks? Is that a better way?
मैं आपको बता दिया कि the mutual fund, see, as I said, 12%, then this is a reasonable way of doing it. You do stocks, that stock may do fantastically well for you, right? Fine, God bless you. But if it doesn't, then you have to start again from scratch. Right? So these various pathways exist. We have to look at the pathway with highest levels of reasonable probabilities. Yeah? Somebody says, okay, there's a startup, invest in the startup. Be clear in your mind that if there are 10, 20 startups, one of them is going to succeed, the rest of them, they're not going to succeed. So your return is going to be 0 in this. Right? You were looking at 20% IRR, but you could get 0. So isko, just examine these things, and your money is hard earned, very dear, and therefore choose sensibly and well.
Yeah. Yes.
Okay?
Yeah. Thank you.
I think you raised one important point, which is that people are living longer and longer, and want to retire earlier and earlier. That means they have to live that many more years without income.
Also,
Absolutely. Very valid.
thank you.
Thank you. Thank you.
Good evening, sir.
Hi.
So suppose like a person, like 2 3 people, or suppose a person has an income bracket, has retired or is working, has an income bracket of like keep it 1 crore, 2 crores, and all, and he has parked it in and fixed deposits and maybe insurance and maybe gold. So why would you suggest that he and fixed deposit itself he is getting that much income to at least run his life? So why would you suggest that in that maybe 10 years, like ma'am showed, that maybe in 10 years you can earn at least some amount of money? So why would you suggest that we invest in mutual
No,
funds?
I'm not suggesting.
No,
I'm
saying, like,
suggesting.
can we
Again,
invest?
ask yourself. See, the first slide was objectives.
Yeah.
If my objective is 12%, this is what I need to do. What you're saying is that here is a gentleman who has a couple of crores of deposits. At 6%, he's earning 12 lakhs per annum, and 12 lakhs is more than sufficient for him to look after his needs. What is the need for him to take any
Mutual
risk?
funds, yeah.
That means that his objective is 6%. For 6%, I don't need to do a 12% investing. Then I can continue to be in deposits. But the aspiration is yours, now, my friend. You decide as to what objective you want to have. I don't. So if you know that inflation is 6% and you choose 6%, you have the consequence of that, which means that you have used the income, but 5 years later you realize that the purchasing power of your 2 crores has come down. The consequence is yours. The objectives are yours. The strategy is a fallout and an offshoot of your objectives. Right? So I'm just suggesting a pathway. I'm not selling you mutual funds. Please don't get that. I'm suggesting that if this, then this, if this, then this, do your objectives, do your strategy, and these are, directional thoughts in fixing your objective and strategy. Is that okay?
That's what.
Okay, lovely.
Do you want to say anything about wills?
Well, I think that this is the broad area of estate planning is one of the most neglected part in our Indian society. And what does this do? So if I don't create a will, it keeps things open, and therefore it has implications on wealth being lost as well as disputes being created. Now, you influence your family's life after you go. How do you do that? You do that by having a proper will. So then you're influencing them that, hey, this is the behavioral pattern that you must have. But if you don't leave a will, then it's all in the air. So you're taking a risk in terms of the wealth values, wealth being lost because people don't know of it. And third is interpersonal stuff that might happen because you've kept 5 questions, 10 questions unanswered. Yeah? So it is very, very sensible, in my opinion, to make sure that a will is created. Now, if there is some assets, there is a will. And the youngsters are building assets. So at some stage, they should create a will.
Good evening, sir. Thank you so much for the insights. So my questions pertaining to the ride of the NFTs and the crypto. In 2022, do you think A, crypto is just the flavor of the season and a fad? Or B, the second part of the question is, does it belong to our portfolios right now?
Go back to the question of objective. if I need to have and fulfill an objective of 12%, do I need an investment that can go 50% up and 60% down? Right? So I think we go to strategy without sort of solidifying objective. And that's one mistake that many of us do. We talk of option B, option C, ye kare, wo kare. But for what purpose? Define the purpose, then the strategy. If you go and delve into strategy without having clarity on purpose, then all these questions will keep coming to your mind. Right? Having said that, I'm a very small man in this whole area of investing. You look at Warren Buffett's views on crypto, and he's basically not recommending it. Yeah, to put it very mildly.
Good evening.
Good evening, sir.
Mr. Rawal and Aarti. Nice to see you after a long time. I'm here just to improve the average age of the questioners, because, and since we're talking about nest egg, etc. So, one question or something which one comes across in reading and literature is this so-called rule of thumb of 30x, of 30 times your annual requirement. What should be the size of your nest egg at the time of retirement? That a good or a useful rule of thumb is 30 times your annual expenses is a good number. Now, I don't know in what context that was set up, whether that was in the US or India, what age and time. Is that something you have any comments on at all? Or that's hackneyed now, it's because people live much longer, 30 may have been based on a certain assumption of retirement age and certain, any thoughts on that?
I never, said that I was well read, and I'm a Punjabi like you. So therefore, I have not come across.
So I've
this.
surprised you.
You've surprised me. I'm not heard of this, but I can, read up and come back to you on this thumb rule of 30x.
It is, as you said, I think a model was shown. If you want so much to be spent for 25 years after retirement, you need so much corpus. And they found that in the US, over a long period of time, thumb rule was 30x. But obviously, it depends on you.
Yeah, and also, I guess, the economy you're in and the...
Yeah. So I'm saying that do the math, like we've done that math. That if I am at 40 and I need to retire at 60, I can say that, okay, if I am spending 2 lakhs per month, inflation adjusted, how much will I spend? And therefore work back as to how much is the corpus. So that's a more, simple mathematical way. So when you have a simple mathematics to help you, thumb rule is when that math is complex. So.
All right. Thumb rule is out. Aarti will speak. Yeah. All right. Thank you.
I was wondering if you have any specific tips for investing as an entrepreneur, because then there's an opportunity cost, right? Like, do I put the money into my business to help it grow, or do I put it into myself to help myself grow over time? Or my business grow?
The simple thing is that the return of investments for an entrepreneur are, orders of magnitude higher than what you can get through investing. Right? And therefore, the purpose of investing for an entrepreneur outside his business is more from the perspective that, hey, if it doesn't go well, what do I bank on? Yeah? But that's the proportion that you have to work out. That how much of safety do I want to create? Because there are two objectives. If you put it in the business, it can grow. Second is that you have to tackle with the risk of that not doing well, what do you do? So do you want to start from scratch, from the road? Do you want to start from a cushion of X? You want to start from a cushion of Y? That's the call that you have to take. And depending on what that call is, then mathematically build that.
And what about the fact, like, at least for me, I am an entrepreneur and I don't have a fixed income anymore, which I did earlier. So what's the best way you go about investing then?
No, so if you don't have a fixed income, then that means that you are getting variable income from your business. So which means that there is 1 month where you have it, 1 month you don't. So therefore create a corpus outside that can supplement the months that you don't. The second is, hey, I'm an entrepreneur. I won't have any money to take from my business because it's not generating any money. Then what's my expenditure, and therefore what kind of corpus to have outside which will keep me alive? Yeah? So it's something that you have to work out case by case, and then so there's no thumb rule there.
Unfortunately.
I don't know.
Yeah.
I'm not familiar with too many thumb rules.
Thank you.
Thank you.
Good evening.
Good evening, sir.
I'm a retired person, retired almost 7 years ago, and both children are abroad. So many times this thought comes to my mind that what happens if I outlive my saving? So just wanted to ask you that if you are aware, is there any scheme by government that I mortgage my house to the bank at some point of time, and the bank keeps giving me some money on a monthly basis, as long as I am alive, and if I'm not there, to my wife, and after that bank takes over, that's it.
No, there is this, I think SBI has a scheme, it's called the reverse mortgage. So you can do that. But the rates of interest which are charged in that are, the last I was looking at it, was quite exorbitant, you know. So it could be 10-12%. So basically, how does it work? That gives you, say, whatever, 10 lakhs, right? Now, that 10 lakhs in terms of liability is being compounded at 10%. So supposing we live for another 10 years, that 10 lakhs is compounded by that. And once I'm not there, they sell the house and recover the outstanding from that, from the proceeds of the house, and give the balance to the children. So what's happened is that cash flow that they gave you is like a personal loan. It's very compounding at very, very large values. So a fair chunk of your property value will go to the bank, and very little will be left for your children. So it's not a very popular scheme in India because the interest rates are not friendly. Now, if the same thing was done with keeping in mind that, hey, they're old people and we need to be kind to them and have reasonable interest rates, it could work. That's why it's not very popular in India.
Some sort of investment advice, if you can give, like what we have done is that we have invested in government senior citizen scheme and PPF, etc., where by and large you still get somewhere around 7.5% to 8%. Obviously, you pay income tax, but what sort of percentage you will advise us to put in the debt as well as equity and mutual fund for a senior citizen?
Sir, again, back to my thumb rule story. Unless and until we do the math of what is the corpus, what is the requirement, because the answer will vary significantly. ना किसी के पास अगर 5 crore है तो उसके लिए कोई आंसर निकलेगा. किसी के पास, if he's got only 50 lakhs, if he has 30 lakhs. So, to give some kind of a thumb rule answer in this is fraught with danger. And why I'm saying danger is that somebody might listen to me and do that, and not knowing the full picture of that person, that advice may be dangerous for him. So I don't want to do that. So get whatever it is, request some, your bank or whoever, they have these financial planners and so on and so forth, sit with them and get it done, or, wherever. So anybody, any person who knows it, contact them and they'll do it, and somebody will help you out.
Thank you.
Yeah? Thank you.
Any other questions? Okay, thank you very much. Thank you, Rakesh. Wonderful session.
Thank you very much. Thank you. Thank you all for coming.